There are two types of people in finance: people who manage money and people who manage the perception of managing money. And for most of your life, you've probably assumed those two things are the same. They are not. Not even close. Because here's something that nobody tells you when you walk into a financial advisor's office: sit down in a leather chair and hand over your retirement savings. That advisor, the one with the framed certificates on the wall and the practiced handshake, is not legally required to act in your best interest. They are legally required to recommend something suitable. And the difference between those two words has quietly cost American investors hundreds of billions of dollars. Let that sink in for a second. Not your best interest. Suitable. Which, in financial regulation terms, means good enough not to get us sued. It's the financial equivalent of a restaurant that only has to serve you food that won't immediately hospitalize you. Technically edible? Fine. Optimized for your health? That's not what we agreed to. Here's where this story starts. Back in 1940, Congress passed the Investment Advisors Act, which was supposed to bring some order to an industry that had spent the previous decade doing whatever it wanted, which largely involved selling people garbage during the Great Depression. The act established something called the fiduciary standard, which sounds boring, but is basically just a legal requirement to put the client's interest first. It applied to registered investment advisors, and it seemed like the problem was solved, except it wasn't, because Wall Street immediately started building a workaround. Broker-dealers, the people at big wirehouses who manage most retail accounts, lobbied aggressively to stay out from under the fiduciary standard. Their argument? They weren't advisors, they were salespeople. And salespeople don't owe you their loyalty. They owe you a pitch. And because of that, they fell under a different standard, the suitability standard, which simply means the product they sell you has to be suitable for your situation. Not optimal, not best in class, just suitable. And here's the thing. That distinction sounds abstract until you follow the money. Because the suitability standard creates a legal permission structure for something called a conflict of interest. And conflicts of interest in finance are not a bug. They are a feature that the industry has spent decades protecting. Here's how the math actually works. Two mutual funds exist. Fund A charges 0.05% annually in fees. Fund B charges 1.2% annually in fees. Both are suitable for you, but Fund B pays your advisor a higher commission. Under the suitability standard, your advisor can legally recommend Fund B and never mention Fund A exists. They're not lying to you. They're just omitting the part where their incentive is to make you pay 24 times more per year in fees, so they can earn a better payout. And that's not a hypothetical. That is the industry. A 2015 study by the White House Council of Economic Advisors estimated that conflicted investment advice costs American retirement savers around $17 billion every single year. $17 billion annually, quietly. Because the guy who's supposed to be helping you is structurally incentivized to help himself first, legally, with your full signature on the dotted line. Now if you're thinking, okay, someone must have fixed this, you would be almost right. In 2016, the Department of Labor introduced the fiduciary rule, which would have required anyone giving retirement advice to act as a fiduciary. Wall Street spent over $100 million lobbying against it. The rule was vacated by a federal court in 2018 before it was ever fully implemented. In 2020, the SEC introduced something called Regulation Best Interest, which sounds like it fixed the problem. It did not fix the problem. Under Regulation Best Interest, brokers still don't have to act in your best interest. They just have to act in what regulators call your best interest at the time of the recommendation, which is a phrase so carefully worded that it says almost nothing while sounding like it says everything. Consumer advocates called it the best interest in name-only rule, which honestly tracks. So here we are, 2026. The fiduciary gap is still very much alive, and most people have no idea it exists, because the industry has become extraordinarily good at making it invisible. Which brings us to the mechanism, because the suitability standard doesn't just create a conflict of interest. It creates an entire ecosystem built around one. Meet the 12b1 fee. In 1980, the SEC introduced Rule 12b1, which allowed mutual funds to take a portion of their assets every year and use it to pay for marketing and distribution, which sounds like a fund expense. And technically, it is. Except in practice, 12b1 fees mostly function as a recurring commission paid from your account to the broker who sold you the fund every year, whether they do anything for you or not, like a subscription you never signed up for and can't see. The average 12b1 fee is around 0.25% to 1% of assets annually. On a $500,000 portfolio, that's up to $5,000 per year flowing from your retirement account to someone else's paycheck for work they already did when you first signed up. And that's before we get to annuities, which deserve their own video and probably their own criminal investigation. Variable annuities are some of the most complex, expensive financial products ever created. They carry average annual fees of around 2.5% to 3%. They come loaded with surrender charges that can trap your money for up to 10 years. And they consistently pay brokers some of the highest commissions in the retail investment world, often 5% to 8% upfront. Are some annuities suitable for some people? Sure. Are they sold to people they have no business being sold to? Constantly. Because the incentive to sell them is enormous, and the suitability standard gives brokers the legal cover to do it. The uncomfortable truth is that the word advisor has become one of the most misleading job titles in American finance. Almost anyone can call themselves a financial advisor. There are over 200 different financial certifications in the United States, and most of them require less study time than getting a real estate license. The CFP, CFA, and a handful of others are legitimate. The rest are mostly initials stapled together to make a business card look more impressive. And here's where the psychological manipulation gets really elegant. Because the industry doesn't just exploit the regulatory gap, it exploits trust. Research shows that the single biggest predictor of whether someone hires a financial advisor is whether their parents had one, not financial literacy, not performance data, not fee comparison, familiarity. People hire advisors because their parents did, and then they trust them for the same reason, which creates a nearly frictionless environment for conflicted advice to operate indefinitely. The industry also benefits from something called complexity theater. The reason most people don't push back on their advisor isn't because they're naive. It's because the industry has deliberately made financial products complex enough that most people feel unqualified to evaluate what they're being sold. And when you feel unqualified to evaluate something, you defer to the expert in the room, who may or may not be working in your interest. Legally speaking now, is every financial advisor a villain in a trench coat? No. There are plenty of fiduciary advisors, fee-only planners, and registered investment advisors who genuinely do put their clients first. They're out there, but the incentive structure of the broader industry actively punishes them for doing it well because a fiduciary who recommends the lowest cost index fund doesn't get a 12b1 trail. They just get a client who will probably be better off in 30 years. And that's the part that never makes it into the ads. Brokerage firms spend billions on marketing that looks like trust building. The friendly music, the couple walking on the beach, the reassuring voice telling you your retirement is in good hands. What they do not spend money on is explaining the difference between a fiduciary and a salesperson, because that distinction is worth billions of dollars to them and nothing to you. So where does this leave us? The same place it always does. Looking at an industry that has spent decades telling you it works for you, while structurally ensuring it mostly works for itself. The fiduciary gap is not an accident. It is the product of sustained lobbying, regulatory capture, and a very deliberate decision to keep the average investor just informed enough to feel comfortable but not informed enough to ask the right questions. The right question, by the way, is 4 words. Are you a fiduciary? If the answer is anything other than a clean yes with a signed acknowledgement, you already have everything you need to know. So, before you hand anyone control over your money, I want to hear from you. Have you ever asked your advisor if they're a fiduciary? Drop it in the comments. because I have a feeling the answers are going to be extremely telling.